Hello everyone. This is the column of Armin talks about stocks of Huawei CHIDD. I am Armin today. Let's talk about the traditional sector of transportation. Despite the rise in energy prices, stocks of many transportation companies have been able to shake off the impact of oil prices and could be rising again after this adjustment. I made the following judgment based mainly on the following reasons. First, more companies revised their EPS forecasts upwards toward the end of this earnings season ever since they lowered the expected EPS during the last season. In the case of a contrarian situation, the given upward profit expectations are a reflection of the management's confidence, and it is also the key reason why I think such sectors can be bought after this round of corrections, including that of the transportation. Second, although oil prices are still high, they have already gone past the climax, although there has been a slight rise in recent days, as I expected earlier this year. At the end of June, oil prices will fluctuate within the range for a while instead of returning to the rally. This view has never changed. Of course, someone may say energy prices may rebound, but it is a fact that energy demand has slowed while the supply of which has increased simultaneously. Therefore, I am still able to maintain the same view I made 2 months ago. Transport companies have been benefited as fuel prices have fallen and remained stable. Moreover, let's not forget that today's transportation also includes electric vehicles and other types of clean energy vehicles, such as those that are hydrogen-powered in Japan. Finally, the National Activity Index released by the Federal Reserve Bank of Chicago on August 20, 2022 shows that aggregate consumer demand remains strong, which not only benefits the freight industry but also self-driving tours, e.g. RV rental. Does this all make transportation an often forgotten sector a worthy focus? Next, I will share with you my logic regarding focusing on this sector and explain my personal views for your reference. When I think of transportation stocks, the first thing that comes to mind is how dependent they are on oil. Considerably speaking, most economic sectors in the industrial society are dependent on oil. The fact that there are more industries directly related to oil prices than any other industry made oil the blood of industry. The hurdle of oil prices also kept me from diving deeply into the field of transportation for quite a while, until a penny stock company released its earnings report that piqued my interest in the industry. I dug into some of the companies related to this field and expected these stocks to stand out in the current economic downturn. When I want to study more about an industry, I first go to the major investment banks to see the current average ranking of the industry via their analysts. Then I select the top 30% of the industries on average. For this 30% of the top industries, I substitute the weighted average of the revised profit forecasts of companies in their industries into my own mathematical model in order to perform further selections and rearrangement. As August draws to a close, most companies' earnings reports have already been announced. There is going to be a big drop in valuations again. That is, predicted valuation models are relatively stable in the weeks following earnings season. What surprised me this time was that after I followed the aforementioned steps, an inconspicuous industry entered my field of vision, the transportation sector. The sector ranked within top 3 in terms of earnings for 2 weeks in a row based on valuation called LCULATIONS, instead of the field of energy technology or medicine that I had imagined. This caught my attention. Until last Christmas, my view had been that transportation stocks have reached their climax and would enter a long down cycle. At the same time, I also warned on my subscription account that I have already liquidated all the large number of shipping stocks, SNI, and other transportation stocks I bought in May 2021. At that time, it was expected that the cycle should have a chance to return no earlier than a year. However, the valuation of the entire sector has undergone a dramatic change for just under 9 months. Before we dive any further, let's review the rationale and the headwinds that I have faced. 1. Unliquidated shipping stocks and other stocks that are related to transportation. The first and most obvious hurdle any transportation stock has to overcome is the rise in oil prices since the middle of last year. Although oil prices have retreated some time ago, they have rebounded recently. Of course, the rapid rebound of oil prices is also indispensable for the stock market effect. Buffett's firm H. Holdings of Occidental Petroleum Corporation (Oxy) and initiated acquisitions have undoubtedly enhanced the confidence of oil investors in the market. Oil bulls in the market see some signs that prices will stop falling and will soon recover above $100, one reason for which is that OPEC has already exceeded its maximum capacity, while China is still imposing a lockdown with a COVID-19 policy. China is a major importer of oil, and their increasing demand will push up oil prices again after the NITI on is fully reopened. However, I think demand will be dampened to a greater extent as the pace of Fed rate hikes and balance sheet reductions increases the probability of oil prices breaking through $120. Again, it's very low, and even if it breaks through the range between and $110, it will not deviate too far. Although higher oil prices will drag down earnings due to market-wide factor inflation, the company can relatively easily pass on the cost of rising oil prices to downstream users. Having said my understanding of the impact of oil prices, I am optimistic about this industry, also because of the fact that the recent financial reports of major retail giants, including but not limited to Walmart, Target, Home Depot, Lowe's, and other companies, showed that the inventory levels have increased more or less over the past 2 quarters. We've seen inventory turnover issues at Walmart and Target, 2 of the nation's largest brick and mortar retailers. Their CFOs all express a high level of concern about their inventories. One of the worthiest of scrutiny is Walmart. As financial report, Walmart's earnings report showed more shoppers heading to its brick and mortar stores and increased revenue, but its inventories were still rising. This has been going on for 2 quarters, according to the earnings data. Walmart's general merchandise is the driving force that attracts most customers to brick and mortar stores. At the same time as foot traffic has increased, other inventories have increased as shoppers focus only on essentials, and in order to de-stock, Walmart will be forced to redistribute the goods it has already delivered to brick and mortar stores, initially driving the increase in shipping. This can also be seen in the recruitment advertisements for its own drivers. Another concern is that the Fed will continue to raise interest rates, which will keep interest rates higher. This doesn't seem to have much to do with transportation. Note, however, that heavy-duty transport vehicles, whether passenger or freight, are not based on a one-time payment transaction most of the time. According to industry statistics, 73.5% of heavy-duty trucks, Optimus, Prime, and large passenger vehicles with more than 50 seats need to pass through finance assistant to complete the transactions, and that percentage would rise to 89.75% if used truck transactions were excluded. While higher interest rates will have less impact on transportation stocks, the underlying logic behind this is that the expansion of such companies will be greatly limited. The logical transmission chain is that higher interest rates will increase the cost of capital for businesses, which will make the IRR, internal rate of return, harder to achieve when the internal rate of return is lower than the business's cost of capital. The company doesn't engage in the work because it costs too much. Interest rates have been trending higher recently, but there are rumors that the pace of rate increases will decelerate. This slowdown will be the base time point when we can expect the Fed to stop raising interest rates, and we believe that once the rate rises, slow down, the Fed should stop raising interest rates within 3 to 6 months, and the market will give expected expectations too. Such an expectation. This may sound a little devious, but the stock market is actually anticipating expectations for the future equivalent to take the second derivative with respect to the expectation. As mentioned above, if we want to make predictions about our expected management, we may have to conduct headwind operations. Note that I'm using a headwind operation here, not a contrarian operation. My trading has always advocated to follow the trend, but the headwind operation refers to the headwind action on the fundamental and macro level, and on the micro-technical level, we still have to stick to the trend. That is to say, on the macro and fundamental level, we can predict in advance that a certain sector may outperform the broader market and choose stocks, but when it comes to the timing of intervention, if you are not a long-term investor, the trend must be traded according to technical charts. It talked about a lack of liquidity over the past few weeks, but the topic could end up being just seasonal low volumes are the norm in the summer, so my fears of rising volumes may be unfounded, but the recent drop in heavy volume tells us that there is no shortage of trading targets in the market. But the bull market has not yet returned. Other headwinds, such as hiking interest rates, inflation, and geopolitical issues, have weighed on the bulls. Most of these issues will be resolved over time, but the geopolitical issues never seem to be really resolved, and appear to be intensifying with Pelosi's visit. Therefore, for large technology companies affected by transnational geopolitics, now should be a period of observation rather than rushing to intervene. Rather, it should be noted that its business is focused on US-based business, while the transportation industry still faces many of the problems mentioned earlier. Most transportation companies have passed the cost on to their customers. Some retailers have high levels of partial inventory, but at the same time, there are massive shortages of essentials. It seems that the industry can find a solution for every stumbling block that hinders its development. We can also see the absolute resilience of the US consumer through the release of the Consumer Confidence Index in Chicago, which has been better than expected several times, but this is also a major change brought about by the low interest rate environment of the past decade. It remains to be seen whether consumers can constantly maintain this resilience as interest rates rise. Still, that confidence is unlikely to wane in the short term as a result, although there are many factors in the front of the transportation industry. I am still optimistic about the industry as a whole. In addition to demand for freight and passenger travel due to consumer confidence, there are many special circumstances in the transportation sector that are meaningful because we are seeing bullish cycles in certain industry segments and bearish cycles in other segments of the industry. As I mentioned in my August 23 stock review, the existing home rental segment in the real estate sector is subdivided bullish, while the housing construction and sales sector is bearish. Therefore, we need to have a unique perspective when picking stocks in the sub-sectors of the transportation sector. Although they all belong to the transportation industry, the actual businesses are very different. Based on the above considerations, I screened 3 stocks and shared them with you, but they are not recommended stocks, and the investment losses are borne by the readers themselves. The first stock is related to a traditional tractor-trailer trucking company named Yellow. Stock code YEL. Its business focuses on the transportation of bulky and light-weight goods. The company has a nickname in the industry called less than a truckload, which could be translated by its literal meaning. It's easy to understand how the company has benefited from cross-regional shipping when looking at its nickname. Trucking companies have responded well to higher gasoline prices with price hikes and fuel surcharges. Despite higher shipping rates, demand for low-volume shipments has remained strong over the past few months, suggesting yield could be in for another solid earnings quarter. Analysts have raised yields EPS significantly recently. I saw the estimate for the quarter rise from 42 cents to 67 cents. There was a similar move last quarter, from 32 cents to 45 cents. Full-year EPS estimates for this year have risen from $0.71 to $1.33, and from $1.06 to $1.58 next year. The company's 5-4x forward P/E ratio makes it a super cheap stock with limited downside and upside, on a premise that the nation's demand for logistics services remains high. There's still a shortage of 100,000 truckers in the US. I think that after the end of this round of market adjustment, there will be better opportunities to participate. Second, let's take a look at another oil and gas shipping company, a business named Goslock Partners. Stock symbol GLOB. This stock truck company is very different compared to road transportation. GLOB is an ocean shipper of liquid natural gas. The business itself might not be intriguing, but the war in Europe has brought such stocks to the fore. Russia is seeking to reduce the amount of gas it sells to NATO countries in retaliation for their support for Ukraine. This has led Europeans to consider alternatives to Russian natural gas, and the best of which is to increase imports of LNG from the United States, and this transatlantic route is the company's main business. However, here is a risk warning. With natural gas prices soaring to high levels, Europe seems to be considering using coal as an alternative recently, but this requires the to abandon the carbon reduction policy they have insisted on for many years. GLOB's EPS valuation has been getting higher and higher over the past few months as the Russian-Ukrainian war deepens. Market analysts have raised the valuation for this year to $1.50 from, and that for next year to from $1.14. But I want to emphasize that even after several upgrades, GLOB's valuation remains low, at just 4 times TTM and only 0.5 times PB. This multiple of PB means the stock is trading at less than half the value of the company's assets. The valuation here is very attractive, with 20% top line growth and an operating margin close to 30%. Of course, once again, we should not enter the market against the trend, but wait for the market to pull back in place before entering at the right time. Finally, let's take a look at a stock that everyone is familiar with, Tesla, ticker TSLA. Subscribers of my show know that I made a big buy when Tesla fell to the range and held the position until August 15 to lighten up as planned. At the same time, I got a huge benefit from performing options carry trades on the stock on a weekly basis. My dream is to trade my Mercedes S450 for a Model X. I love the car, but it will take a few months to get it in stock. Personal biases aside, though, this stock doesn't sound like it has much to do with the transportation industry. But be warned, its electric trucks are popping up all over California, Texas, and Arizona. It makes electric vehicles a growing part of the transportation industry. As far as gasoline prices go, EV, as produced by TSLA, are a great hedge. On the other hand, a risk warning should be made. Not all EVs save money. Depending on where you live, as gas prices go up, so will electricity prices. Natural gas is the source of kinetic energy for generators. Therefore, as prices go up, so do your electricity costs. TSLA has a stock split this week, and over the past few quarters, we've seen a steady post-split growth in popular stocks. Unlike the first 2 stocks, TSLA's valuation is much higher. Current valuation indicates that Tesla needs to convert all family cars in the world into Tesla to support its estimated valuation, but that calculation apparently ignores Tesla's continuous gains in future car software updates. Since the company has shown strong growth in multiple areas, not just in finished vehicle sales, the Market is giving an average forward P/E ratio of 175 times as the market factored in the company's 4.1% revenue growth in the most recent quarter, which also included headwinds from the closure of its most productive Shanghai Gigafactory for about a month. I am now waiting for a buying opportunity after it pulls back again. Therefore, I think that stocks with growth potential can still be found in the subsectors of the transportation industry, and this area deserves our attention in the future. That's all for today's sharing. Thank you for watching. Declaration and risk alert. This article is a personal analysis based on existing data. It neither constitutes a stock recommendation, nor does it induce trading. It does not share investor profits nor bear investor losses. The stock market is risky, and you must be cautious when entering the market. Readers should be clear that investment losses should be borne by themselves. The manuscript and pictures are automatically generated by the system and may differ from personal views. Please watch carefully.